Welcome back. In this video, I want to discuss why the fees you're paying matter and what they actually do to the performance of your investment portfolio. I know when I began my investment journey years ago, I didn't know how to invest. I didn't know what to do. So I went to the bank and I basically asked them to invest for me. And so when you do that, you get asked this investment questionnaire, and it basically determines your risk tolerance, and the advisor will basically sell you a mutual fund based on the answers you gave on this questionnaire. And most of the time, when they go through this questionnaire with you, you'll be given some sort of balanced portfolio, some portfolio that is close to a 60-40 balanced allotment. And what I mean by 60-40 is 60% equity, your risky stuff, and then 40% of fixed income or bonds, so the safer stuff. So 60 risky, 40% safer. And because I started my investment journey years and years ago, I actually don't remember what fund was sold to me or anything like that. So I just did a quick Google here and I found all these funds that CIBC sells. And right at the top, again, probably the most popular fund is going to be a balanced fund. So it's right here at the top, and I just clicked on that and you can see it's the CIBC balanced fund. And when you scroll down, they have a bunch of information there for you. And all I'm interested in for the sake of this video is the fund code so that I can find the fees. And so you can see the fund code here is CIB 477. And so here's the fact sheet for CIB 477. And you can see here that the MER, the management expense ratio, is 2.15. And if you scroll down a little further, there's also a TER, a trading expense ratio, which adds another 0.04%. And so you can see that the total fund expense is 2.19%. And you can see right above it, they even tell you that based on this fund, for every $1,000 you have invested, you get charged $21.90 per year. And when you're first starting out and your fund balance is fairly low, it doesn't even sound that bad, $21.90, especially you're probably new, you have no idea how to invest, you just want someone to do it for you to get started, and you don't actually realize what the 2.19% actually means. It doesn't sound that bad. I know when I had this meeting about these funds, I don't even think I was told what the fees were. I didn't even know where to find the fees. I didn't even know there were fees. Honestly, I didn't really understand the effects of what I was paying. And you can see down below here, there's going to be even more fees based on this fund, but I'm just going to focus on the management fee of 2.19% and what it does to your portfolio. Now, as I started learning more and more about investment fees, I did move my funds out of CIBC and moved them into Questrade for lower fee investing. And then I actually read this book by Larry Bates called Beat the Bank. And he has entire chapters dedicated on what fees actually can do to your portfolio. And he came up with something that he called the T-Rex score. And the T-Rex score, he says, is basically how much of your investment growth do you get to keep based on the fees that you're being charged. And on his website, he has a T-Rex score calculator, and it's a fantastic calculator, and it's eye-opening to see what these fees do. I show all of my students to take my financial class this calculator and what the effects of fees are going to be on their portfolio. All you really need to know is what are the fees that you're paying. So I've changed the annual fees to 2.19%. I left the investment at $10,000. The initial investment doesn't actually matter when you're talking about your T-Rex score. The average annual rate of return I put as 8%. If you're an all equity investor, the worst 25 years in the S&P 500 ever has been 8%. So I just used 8%. And we can adjust those in a second. And I use a time frame of 25 years. So let's click on the update button. And you can see we have a T-Rex score of 53%. That means that you get to keep 53% of all your earnings. The bank, CIBC in this case, keeps 47% of your earnings. You can see here that I should have earned $58,000 in investment growth, but I only got to keep $31,000 of my investment growth. The rest of it, the $27,000 over the 25-year period, goes to the bank. And if you change the annual return to 6% with a safer portfolio, that's generally what you're going to get, you can see that you actually get to keep less of your investment. A 60-40 portfolio will generally probably produce about 6% over the long term. The bank will actually take 53% of your money, and you get to keep 47% of your money. Your portfolio should have grown $32,000, almost $33,000, but you actually only get to keep $15,000 of that growth, which is ridiculous. More than 50% of your growth goes to the bank. That 2% fee annually turns out to be 50% of your income over 25 years. Those of you that have been watching my videos for a while now know that I'm an index investor, and one of the greatest things that I've seen come out in the last little while is the asset allocation ETFs. And you can see here that basically you can own the entire stock market around the world, a globally diversified portfolio, for about 0.2%. So let's see what a 0.2% fee does to your overall performance. So I've entered 0.20 as the fees. And you can see now when I click update, your T-Rex score is 94%. You get to keep 94% of all of your growth, and 6% goes to the ETF company. That means your portfolio would have grown $32,919, so $33,000, and you would have got to keep $31,000 of it. So your overall fees after 25 years is less than $2,000. So like Larry says, that's an easy way to beat the bank, is just by investing in low-cost ETF funds. I invested long before these asset allocation ETFs came into fruition, and so I created my own portfolio, and it is cheaper to do that. It just takes some more work, and my portfolio cost me about 0.1%, and so you can see that my T-Rex score would be about 97%. So really, my fees are about $1,000 over 25 years instead of $2,000 over 25 years. It cuts the fees in half, but that $1,000 is fairly insignificant. So I always highly recommend people just start with that asset allocation ETF. Starting out as a DIY investor, do-it-yourself investing can be scary when you get started. People don't know what to do. I get it. But you have to ask yourself, is it worth handing over 50% of your growth over a 25-year period to the bank to do it for you? And maybe it is. Maybe by investing with the bank, it keeps you from selling during those down markets, and then it might be worth it for you. Absolutely, there's a case for it. But if you can do it on your own, save those fees, you can beat the bank, you can beat those returns that those bank mutual funds are going to get for you. And if you need any assistance with any of that, please don't hesitate to contact me. I'm happy to help you get started. I do hope that this video has shown you the impact of fees and what they can do to your portfolio. If you've enjoyed this video, please subscribe below. And as always, have a wonderful day.